equity is basically, why is the owner interested in the business? And what makes him interested in the business? So, if I look at this, what is the owner interested in? He's interested in the capital. Because what is the capital? It's the money he gave to the business. And what's very important is he took it from his own personal bank account and he transferred it and he paid it into the business bank account. And what do we call the business bank account? The check account. Okay. And we keep it separate. We never mix the two. Then he's interested in his drawings, meaning the money he takes for his personal use. It's got nothing to do with the business, but he's taking business money for personal stuff. He buys flowers for his wife. Okay. And he's interested in the profit. Now, let me quickly explain this to you. You remember we did factors of production, né? And the one factor of production is entrepreneurship. So the entrepreneur is the owner. It's the guy starting the business. Okay? And what does that owner get? What is his remuneration? Let's quickly think. We have entrepreneurship, capital, which is given by the entrepreneur, né? Because we at this stage, we say he gets it, he gives the capital. Then we have, don't say land, because it's not just the land, né? It's most it's natural resources. And what's the other one? Is labor, right? So now what do we know? The labor gets salary, wages. The capital gets interest. The natural resources gets rent. What does the entrepreneur get? Profit. You see how it all works together. So the owner wants the profit. Now can I tell you something, and I want you to hear this. Do the owner only use the profit at the end of the year? So he waits for the end of the year to see the profit and now he's happy because now he can use it.
No, end of the month.
Not necessarily the end of the month. So what most owners do is they draw a salary because they work for the business also. So they're going to pay themselves a salary, which makes sense. Because you can't live from your cash register. You can't say, oh, I need 10 rand for a chocolate and open the cash register, take 10 rand. Can't work that way. Okay. But we say drawings is basically the owner taking from the profit before he even knows what the profit is. Because, let's quickly think. Let's say his capital was 1,000 rand. Right? And his profit is 3,000 rand. And his drawings is 500. Can you see in the end the drawings makes the profit less? The profit is now actually only 2,500 because he already used 500 of the profit. You see? And that's how it works. Okay, are they still bothering you? You must tell me, ne? Because I will move them. Let's go on. So, that's my owner's equity. You can go read on that. I want to know, which is more important in a business? The profit or the cash flow? The cash flow. Why? Why do I need the cash more than the profit? I need to pay my workers their salary wage. I need to pay the rent for the place I am renting to sell from. I need to pay the insurance. I need to pay the airtime. I need to pay the advertising. So can you see, my business cannot be run if I do not have cash flow. Okay. And profit is not necessarily, let's take profit. What did I say? What is profit? It's income less expenses. So your main income is sales. Okay? You agree with me, at this stage of your life, we've only done cash sales, meaning people paying immediately. Later on in the year, we're also going to do that people can buy on account, which most of us do. Ne? Most of us have some or other clothing account or something that we buy on credit. Like if you don't buy a television cash, you buy and pay it off. So that sales is not necessarily all cash. Some of it is maybe someone who still needs to pay me. And that is why I'm saying the cash that I have in my hands in my bank is more important than the profit. Okay, because I need that cash. So now let's quickly look at these words. So if I do the word cash, I'm going to use the words receipts and payments. And you all agree with me. That is what we show in the CRJ and the CPJ. And this is what makes the bank more or less. Right, that's receipts. So receipts and payments is my cash. Income and expenses is in the end my profit. So I use different terms for it. Can you see we are talking a language here? So when I talk income, income doesn't mean the cash I received. Because income can also be people who still owe me money for sales. That sales that I do is cash and credit. So income is not necessarily cash. Okay. Now let's go to assets. So when I look at assets, there's 9 assets. I'm going to teach you 9 assets, and we're going to do them in threes. Okay, so the 9 assets I'm going to do with you. So assets, I'm telling you, there's 9. And I'm going to divide them in a 3-3-3. I'm going to say you get land and buildings, vehicles, equipment. Okay? We call this my fixed assets. Because can you see that these assets I'm going to use for years and years and years and years and years and years and years. Then I'm going to have my bank, my petty cash, and my cash float. Now this is my cash assets. Then I'm going to have my assets that makes me money. That's going to be my stock, my debtors, and a thing I call fixed deposit. So, a fixed deposit, let's quickly just go through what is this. What is the difference between petty cash and cash flow? Understand stuff better if we can see it. So I'm going to go and I'm going to Google a petty cash box. Or petty cash, whatever, ne? Petty cash. And let's go images. There's a petty cash thing image. Have you ever seen this?
Yes.
Yeah. So a business will have a petty cash box. Every business has it. Even our school has one.
Yes.
So when you go and you pay, so a petty cash box is literally if the business wants to buy something quickly with small change. Right. So let's say our office doesn't have any sugar left for coffee. And then we say, oh, will you quickly go buy sugar? And you say yes. And then we take 20 rand out of the petty cash, give it to you. You go buy, bring the change. You see, it's when we want to do transactions that is small. We don't want to do an EFT for it. We don't want to pay with a debit card for it. We just want to give someone cash. That's a petty cash. I'll answer now. Now let's quickly look at a cash register. So a cash register looks like this. Can you see? There's the cash register. And actually, that drawer, I want to see if there's a drawer that opens up. They have drawers like this, you see? And in that drawers, may I speak? In that drawers is what we call cash float. Can you see? There's the cash float. Okay. Huh? So some people, like the tuck shop, doesn't have a cash register. So they use these boxes for their cash payouts as well. Okay? So they would call this their cash float, because your cash float is the cash you have available to give people change. But most shops looks like this, né? If you go to Hyperama, let's see, there's a supermarket one, né? This is what you see every time you go to Checkers. This is, and that drawer there, né, will be there. You see it, full of change. You get it? So now, I had a few. So let me quickly explain to you cash float. So how cash float work is you will always have the same amount of money in the morning when you start and in the evening when you end. So let's say your cash float is always 1,000 rand. So you'll have 1,000 rands changed, 10 rands, 50 cents, 20 cents, 5 rands. Now during the day you have cash sales and you put money in the till and you give out change. So at the end of the day you take your drawer. Have you ever seen the ladies, what they do is they have like a zipped cover.
Yes.
So then they take their drawer out, they go to a safe space in the back, and then they do what we call a cash up. So they take out all the cash. Before they count it, they take out their 1,000 rand that they started with this morning, so that they have change again in the cash register for tomorrow. They lock the cash register, put it in that thing, zip it to, and then they must put a lock on it. Now, the change that they took out, all that money, they count it. And together with the credit card slips and the debit card slips, it has to add up to the total that they have on their cash register roll. If they are short, they have to pay in from their pocket. Yeah. Okay? So that's how it works. So then the manager will take all the cash registers cash, and that needs to be taken to the bank to be deposited. Now we all know it's very dangerous to go with bags and bags of money. So most people have those fidelity guards that come, with the guns, and they come and they fetch the money and they take it to the bank. Debtors control, it's people who owes us, so that's money coming in. What is a fixed deposit? It's an investment. I take money from my account and I put it into another account for a fixed period. And I'm not allowed to touch it. Why would I do it? Because it's going to earn me a lot of interest. Can we quickly